Nur was very instrumental in a deal that I talked about quite a lot on my channel. It was the acquisition of 3 Planet Smoothie restaurants in the Atlanta metro area. And Nur was the actual banker on the loan. But, I kind of wanted to kind of bring this to the attention of our viewers and to our audience, because it's very important that I think, because I'm often asked, like, well, how did you acquire those franchises? And so I really wanted to take this time with Nur to walk you through that deal process. What's up, YouTube and Podcast Nation? Welcome to the From Setbacks to Success YouTube channel and podcast. I'm your host, Quincy Benton. And guess what? I'm a felon. Not only have I served time in federal prison, but I've been divorced, I've declared a bankruptcy, I've even experienced a house fire. Some of you too watching right now have experienced or maybe currently experiencing some major setbacks in your lives as well. However, I want you to know that there is hope and there's a way to get through. Through the content you'll find on this channel, we'll give you tips and success strategies that'll help you get back in the game and succeed. If this sounds like content you would be interested in, please press the subscribe button and smash the like button. We would love to have you as a part of our community. With that being said, let's jump right into today's episode. I'm so excited to have this very special guest. I have with us today Nur Nadir. He is a specialized, high-ranking, high-level SBA lender out of Los Angeles, California. Nur, again, welcome to the From Setbacks to Success channel.
Quincy, I just want to say, of course, hello to you and your amazing audience, and thank you so much for having me.
Absolutely. And I'm so glad to have you here on the channel, and I'm very truly excited to give the information that you're going to share with our community today. And I want everyone listening and watching right now to lock in, because Nur has some gems to give you, particularly for if you are a entrepreneur, you have entrepreneurial interests and goals, and not only just basic entrepreneurial goals, but high level goals, because that's Nur specializes in a very unique space of SBA lending, where most of his loans are $750,000 to $3 million package deals. So if you, so we're going to get into some of the types of deals that he could help you with. If you have businesses that you would like to acquire, like franchises, or you have some expansion of a current business that you have going on today, Nur can help you with these particular types of deals. So Nur, just for our audience, kind of give them a little bit of background of what you're doing, who you are, and we'll just start from there.
Sure. So again, Quincy, thank you so much for having me. I am a banker. I work for a commercial bank in Los Angeles, and my specialty over the last 10 plus years has been to provide SBA loans. SBA stands for Small Business Administration. It's an entity that was set up by the federal government back in the 50s. And the whole purpose of that entity was to allow, basically, it was set up to support banks to lend to businesses that typically might not get a business loan. So basically, as we all know, they're banks. You can go to a bank and you can say, hey, I want to borrow, I don't know, $1 million, right, for your startup. Or maybe it is an existing manufacturing company or a retail business. And sometimes banks don't want to lend because they don't like the collateral structure, or maybe they don't like the industry. And the reason typically banks might not like something, and I'm kind of talking, I'm trying to talk in simple words, but typically the reason why a bank may not be as excited about a particular industry is because they're worried about taking a loss. Or they're worried about the collateral structure. And what I mean by that is this: if you go to the typical retail business, let's just say the business sells ice cream, let's just say, if the business can't repay the loan, there really isn't any collateral that the bank can sell to repay the loan.
Okay.
Because by the time the bank were to get to the closed business, the ice cream would have melted. Literally, the ice cream would have melted.
Right.
So the
Right.
bank, we can't sell ice cream to repay our loan. So that industry, generally speaking, the banking industry is not going to be as excited about to lend to it. So what the SBA said is they said, hey, look, bank, you're correct. Ice cream is going to melt by the time you get into a liquidation scenario.
Right.
However, there are people who are successful at selling ice cream, right? You know what I mean? And those people create jobs. And
Yes.
we think that this would be helpful if we can still lend into that industry. How about bank? If we provide a partial guarantee, you lend that ice cream business owner $200,000, we will provide a 75% guarantee, right? Not 100%, but a 75%. So
Okay.
if they go into liquidation and there isn't any ice cream to sell, any collateral to provide to pay down your loan, we government will write a check for 75% of your loan. Meaning, if that ice cream business owner owes you $100,000, we will write you a check for $75,000.
Okay.
So you don't get your $100,000 back, but you get $75,000 back. And as a result, your loss, bank, is less. And guess what? The banking industry said, we like that idea.
Okay.
And, you know, for 30 plus years, SBA loans have been a big piece of the banking industry.
Okay.
Initially, what's important to note is that the bank will lend $100,000, right?
Right.
And the government is going to provide, the SBA is going to provide a partial guarantee. So that's just kind of like in a nutshell of what.
And I do understand, and that makes a lot of sense. And I guess I'll just kind of try to, you know, condense that for our viewers and listeners, is that that the loan that is given in these business deals is backed essentially by the government. So it creates mitigates some of the risk that's involved for the bank itself in making these loans to potential clients, potential borrowers of the particular loan. Would that be correct?
Yes, exactly.
So the reason why I wanted to bring Nur on, Nur was very instrumental in a deal that I talked about quite a lot on my channel. It was the acquisition of 3 Planet Smoothie restaurants in the Atlanta metro area. And Nur was the actual banker on the loan. But, you know, I kind of wanted to kind of bring this to the attention of our viewers and to our audience, because it's very important that I think, because I'm often asked, like, well, how did you acquire those franchises? And so I really wanted to take this time with Nur to walk you through that deal process. So one of the things that is important to know when people, you know, with business owners, and we talked about this, Nur, as well, is that, you know, it's so important to have relationships and network. And so one of the things that part of the relationships that I was able to achieve was with a business broker. This business broker essentially acted like a real estate broker, where she had a network of people, business owners, who were, you know, for whatever different reason, you know, a variety of reasons, were wanting to sell their businesses. It just so happened that this one particular person or client that she had owned 5 Planet Smoothie franchises and wanted to sell. He had, you know, worked the business for a number of years, just was wanting to make a transition and do something different. So this particular person not only knew the owner, she knew Nur, the lender, as well as there was if I can recall, there was a actual business attorney, a tax attorney that was a part of the deal as well, because there's in this process a lot of legal work that goes into these particular deals. So just kind of doing a little bit more, you know, kind of playing of how the process went. You know, I had to come to the table with a certain amount of credit, as well as a certain amount of cash, and we talked about that, Nur. What was the deal? It was about how much at the time?
Yeah, just plus or minus, and I'm, you know, going off of memory, but I think the purchase price was about 600,000.
Okay, yeah.
And
so
the generally a bank, and at that time the bank required that you put down roughly 10 to 15% of that. So I think you put down anywhere from $60,000 to $75,000 of the purchase price. And then there was a small, I think we were, because you and I were triaging from a memory perspective,
Right.
and there was not a seller note. Sometimes the seller will carry back paper. What does that mean? It means that the bank will lend maybe 70% of it, and then the seller is paid back a percentage of the purchase price, call it 10%, call it 60,000 of this particular deal is paid back over time. You would pay them, you'd pay me back over 10 years, and you pay them back over 5 years. So that way they don't get all of their money at the close.
That's correct. That's correct. And can you also just talk about the seller? Why is that important in these types of deals, and how that can be beneficial in the structuring of these deals?
Yes. So at the end of the day, the reason why that's beneficial to the buyer, in this case you, is that when you buy a business, just like any other asset, there may be challenges within the business that aren't apparent immediately, right? And so let's just say that the seller said that the business is going to generate $100,000 on an annual basis in terms of net profit, but you buy the business and you find out that you've got to put $20,000 into the business because there's some sort of a expense. Maybe you got to buy refrigeration immediately, right? So now that profit gets reduced by $20,000 that, the seller may not have been aware of, but you certainly as a buyer weren't aware of, right? So now if you've got what we like to call it, bankers, we call it skin in the game. If you now owe the seller $50,000, it's going to force them to certainly be available to you. If there's questions, certainly be available to you if issues come up, because you owe them money, quite frankly. We call it skin in the game. Skin in the game,
yeah. So I think that, and thank you for sharing that, because I think that's valuable to have that information. Again, I know that there's quite a few entrepreneurs that we have, and even that goes into, I guess, and I'm kind of going to hit things on different levels. I'm just not going to go through this straight through, but I know for our audience, a large part of our audience are people who are men and women who are formerly incarcerated. Sure. And so, why is this important for people who are formerly incarcerated? Can you get an SBA loan with a previous conviction on your record? Yeah. So the short answer is yes, but I want to caveat that with the fact that whether you're a felon or not, banks must adhere to what they call the SBA standard operating procedures. What is that? It's literally a 100-page document in which the SBA states that to provide an SBA loan, the banks must do X, Y, and Z, right? And it could be anything from, you must have a certain amount of down payment. It might be, within the standard operating procedures, for example, if you obtain SBA loans over $350,000, for example, technically the bank, if you own a home and you have equity within a home or any commercial real estate, the bank must file a lien against that. Okay. I'm just giving you some examples. There's a bunch of other standard operating procedures. So the underwriters for each bank have to make sure that those standard operating procedures are followed. And sometimes that can be very messy. So I want to be very clear that I'm not an underwriter, but I do understand high level of standard operating procedures. So on a high level basis, and let me also add this fact, the standard operating procedures do change every year. Sometimes they add standard operating procedures, they being the SBA, they add standard operating procedures, and sometimes they remove some. But technically, if you have a felony on your record, that does not automatically eliminate you from obtaining SBA financing. Okay. However, if you do have a felony on your record, first of all, my recommendation is that you disclose that to a banker immediately. Absolutely. You want to let your banker know up front, because they have to document it. And for most felonies, if not all, the bank must send the package documenting the felony and what occurred and whatever the judge said
that was required for the felony. They have to document if those requirements were met, and then the bank must send that to the SBA office in Washington, D.C. But I do think it's important to note that if you have a felony, no, it doesn't, automatically disqualify you. I think whether one has a felony or not, the key thing for communicating with your banker is to be transparent.
Be transparent. Yes.
Yeah. Then what does that mean? If we're talking about a felony, yes, but also maybe an individual might have a bankruptcy, or maybe an individual is going through a divorce.
Yes.
That happens, right? You know what I mean?
Right.
And so you want to be upfront with your banker, and that helps to develop a relationship with your banker. And without a relationship with your banker, it's pretty difficult to proceed just in general.
I do understand, and thank you for breaking that down. And I'm sure everyone watching will appreciate that. So going a little bit further, again, some of the things that I had to bring to the table was credit. I had to bring cash. In this particular deal was about 60 grand. And then I had real estate. And so those were some of the collateral that you will find is often needed on some level. Can you talk about that just a little bit, the collateral, and for those people who are watching who may, not have collateral, they may have the cash, they may have the credit. Can they still get a deal like this done without collateral?
Yeah. So the short answer is sometimes, and the short answer, first of all, the real short answer is yes. Someone can obtain an SBA loan without collateral. First of all.
Okay.
I think the key thing, though, is that every deal is on a case-by-case basis. And if you take a step back, the question is, how does a bank determine whether to say yes or no to a business loan?
Right.
Whether it's conventional or, SBA or whatever.
No.
And there's a couple of factors that banks consider.
Okay.
They consider, usually, especially for a small business acquisition experience, right? Do you have some retail experience?
Okay.
Maybe you're buying maybe you're acquiring a nursing company, for example. Do you have medical experience? Are you a nurse yourself, right? Because banks, we like to say that we're not great at managing businesses. We aren't, because there's so many different industries that exist, and there's so many nuances within the industry. So certainly experience is important. And when you go to apply for a business loan, you want to highlight that pretty quickly. Now, if you're acquiring a gas station, some of us didn't go to college to run a gas station.
Right.
So I'm not going to say that every business, there's some specific experience or degree. But, I would also say that some business owners sometimes don't realize that they have indirect experience that are germane, and it might be from college, right? It might be from right out of college, maybe when they were a bit younger. All of that is very relevant because you understand, again, the nuances. Maybe you worked at a hotel, maybe you're trying to buy a hotel or
Right.
a motel, and you worked at a hotel and you just forgot. I sometimes that can occur. I start to ask a lot of questions about the background of some individuals.
Okay.
that person might dismiss. So experience number one is important.
Gotcha.
Do you have the down payment? Yes, that's important. There's some people, look, if you're going to acquire a business, I want you to at least have 10% to put into it. Again, if the purchase price is $500,000, you need to have at least you're putting $50,000 into it. And then after that, do you have reserves, personal reserves, 6 months for you and your family, just you personally, right?
Okay.
And then do you have some business emergency money? Emergencies occur. Things happen that are unforeseen. Again, maybe you're buying a company that has refrigeration and you got to spend and write a check for $10,000. That can be a surprise.
Right.
And then the last piece of it is collateral. Does the business have collateral that I can sell as a bank in a liquidation scenario? What does liquidation mean? Meaning you can't make the payments. I have to take over the business and hire an expert to sell the business assets. Are there some business assets? Again, if it's a consulting company, if it's a retail company, you're not going to have a ton of collateral.
Right.
So then the backdrop is the SBA and the bank says, do you have real estate collateral? Right.
Okay.
Some people, again, do, some people don't. The larger the loan, the more collateral I need. Do I need a lot of times people will ask me, what's the percentage of collateral that I need? Mm-hmm. There really isn't a hard and fast rule, and that frustrates people
Right.
As a banker, I want as much collateral as I can get, but do I need 100%? No, I do not.
Okay. Got you. Got you. And I think that does provide some context to how the deals are structured. And I hope that people will find this helpful in trying to figure out how they're going to finance their deals as well. So, with that being said, I kind of want to ask you about some of your actual experience because for me, it was a, retail deal with the Planet Smoothies. For others, it might be something else, might be something different. What are some of the other types of businesses or types of businesses that you finance? Give me just kind of some, without revealing any personal details about your clients, but just give me a few scenarios of different deals that you've worked out.
Yes, I helped an IT technology company, that generated, 10 plus million in existing revenue, acquire a company out of state, meaning they exist in one state, they exist in California, and they bought a company out of state, and that company that they acquired was generating 10 plus million in revenue themselves. And
Okay.
for them, it was really about scale, meaning the larger that they are, the more efficient that they can be from an existing employee perspective, right? Because they could acquire this company, acquire the accounts, but they didn't need to take on the overhead, certainly of the executive team, right? So
Okay.
now they've got their executive team, HR, CFO, et cetera, and now they get to bring on these accounts. And so from a margin perspective, they can increase their gross margin in a profitable way. So it was really helpful for them to acquire this company. Obviously they completed due diligence to verify that revenue was there and that the accounts, met the actual verbal, met the actual financials, right? Because
Right.
one thing to
Right.
provide financials, but you want to complete due diligence to verify that the revenue is actually coming in. Yeah, the purchase price was $4 million, approximately. The bank lent about $2.5 million, via, again, an SBA loan. The buyer put down roughly $1 million, and then there was a seller note of $500,000. So in our view, like, that's a nice combination of sharing risk.
Okay.
And the other thing is, let's just say, and I don't remember the actual interest rate, but I think it was in the range of 5% roughly, in terms of the interest rate paid to us. The benefit to the buyer in that case is they pay us 5%, and let's just say that the net profit that's achieved is 10%, right?
Okay.
Meaning before they pay us 5%, after all expenses, they earn 10%. So 10% net profit, so again, let's say, let's just say,
Yeah.
top line revenue is $1 million, and then of that, they net $100,000. Let's just say,
Right.
I'm just using that as an example.
Mhm.
So that's 10%. They pay me 5%. Their net now is 5% that goes to the bottom line, right?
Okay.
So they're generating, after cost of capital, right? Cost of my capital, they're generating a 5% return, right?
Right.
So, and they're doing so without adding on any other expenses,
Okay.
right? You know what I'm saying? Because they keep their existing expenses. So long-term 5% each year, that adds up. That that after 5 years, that's a nice return, right?
Right.
They may even reduce some of their expenses long-term by bringing on some new accounts versus having to hire more people or increase expenses, if that makes sense,
That
to
does.
to get the return. So SBA can be a nice way to build your profit, to scale your business, increase your business. The other component of it is there isn't a prepayment penalty for
Mhm.
10-year loans.
Okay.
There is a prepayment on the real estate loans, 25-year loans, but the loan can be repaid back early if it makes sense.
Okay.
For the
Okay.
business owner.
So just to try to play that back, I want to, I know we have a very sophisticated audience here, but I
Yes.
do want to try to break it down as much as I can. So one, we're talking about still the SBA 7A loan. This was a 7A loan. So for everyone, that this would be the type of loan that you would apply for and ask for specifically if you're interested in acquiring a business at larger scales. Again, we're talking about $350,000 and up to about the $3 million range. And we're
if I may
saying,
interject, Quincy,
yes.
that's kind of like the ballpark
Okay.
that some lenders play in, but technically there are SBA loans as small as 50,000. The max 7A loan, without getting into the weeds too much, is 5 million. Technically, someone can obtain, subject to bank approval, of course, a $5 million 7A, but kind of the ballpark where I've played is kind of more in that 750 to $3 million.
I got you specifically for the type of clients that you're looking for.
Yep.
So with that, again, you mentioned something called due diligence. So in these deals, you want to make sure that the numbers in everything that the seller is saying, it checks out to be true. And so I guess part of your due diligence team, you would need maybe for a buyer, an attorney, as well as an accountant to look over the financials. And what would you say to that?
Yeah, it's a good question or a good point to make, Quincy. So I think all of us, what I would say is this: due diligence is very important, right? And so
Right.
As a buyer, and I'm not a due diligence specialist, I'm not a CPA, I'm not a lawyer, but generally speaking, my clients have a lawyer, they have a CPA that would support the buyer in making a final decision to proceed or not.
Got you.
There are also due diligence specialists that focus on verifying the data that's been presented by the seller, right? So meaning the seller will provide you with some financial statements, they will, provide you with some corporate tax returns. And, how do you verify that, right? Well, a
Right.
CPA firm have ways, systems in place to do so. Now, banks and the SBA do require that, the SBA has a requirement that the corporate tax returns provided by sellers must be verified with the IRS. That's something that the SBA will do. Meaning, you provide me your corporate tax returns. There's a third-party service in which they will verify that the IRS has the same numbers, right, that you've provided to me, to make sure that there aren't two different books being managed. So that's a requirement. That's a due diligence requirement that the bank is going to, is required to complete, and banks will do. Having said that, my recommendation is that everyone completes due diligence. No different than if you're buying commercial real estate. If you buy a house, right, you're going to hire, a home inspector, right?
Yes.
And
Right.
et cetera, et cetera.
Yeah. And that's, you got to find out all the information as a buyer that you can on the asset being sold, so that you understand exactly what you're getting, because unfortunately some sellers don't disclose everything. Sometimes they're not even aware, like you said, in some cases, what the problems might be in their business. And so, but it's up to you to and your team as a buyer to get those things figured out, so that that you're buying exactly what you were expecting to buy. And so
I think your overall point is very apt and important. You need to have a team, right?
Yep.
I would respectfully say that part of that team, CPA, a lawyer, if it's real estate related, you certainly want to have some appropriate real estate due diligence folks out there. In commercial real estate, an environmental report is something that is required by banks, and obviously an appraisal. But you want to have your team, and that, Quincy and you and I talk about this.
Yep.
Finding the appropriate players for your team is important, based on cost, based on location, and you want to have relationships where you focus upon. I guess what I would say is this: how do you build your team, right? And it's going to be based on relationships, right? So that, I can call you, Quincy, and say, Quincy, I need an expert for retail. right? You know, do you know a CPA that focuses on retail? And then from there, you basically, because of your relationship and your knowledge within the space, you're in a position to say, Nur, call X, Y, and Z.
Right, right. Thank you. Thank you. I appreciate you sharing that. So just moving a little bit beyond, we understand what it takes to do the finance. We talked about what it takes to evaluate the deal, to get the, correct people, to help you evaluate that deal. We also talked about some of the, the levels of loans and the range in terms of SBA loans that you can do. Let's talk about a little bit on the back end. Why would someone want to acquire someone else's business? And then the other part to the conversation would be like exit strategy, because I know for me, it was, and I can share that a little bit later, but I want you to talk about some of the things that a buyer would need to keep in mind in terms of your exit strategy, in terms of your long-term plan.
Yeah, I mean, I think it's a great question, Quincy. I think again, determining your exit is important, right? No different than, I guess acquiring a piece of stock or maybe even real estate, right? I guess, one of the things is I talk to experts within the investment world, be it CPAs, be it financial planners. You always want to define your exit before you complete the investment, right? And again, I'm not a financial planner, I'm not a CPA, I'm not a lawyer, I'm always going to disclose that, but I certainly like to ask questions because I want to be a resource, for people like individuals like yourself and certainly clients that approach me. And so, I do think it's an important question to ask up front, right? You buy this business, what is your exit? What are your goals? Maybe you want to keep it forever and transfer it to your heirs. Maybe you want to sell it within 3, 4, 5 years if you get the right, return. And so, I don't want to answer that question because I think it's different for everyone, but I think you make a very important point. I frankly don't think enough business owners think about it, frankly. What is my exit? And I think what you want to do is, again, have your team. You want to have your financial planner. You want to have your CPA. Because when you think about exit, there are tax implications again. CPA,
yes.
There's tax implications, right?
Right.
And that means different things to different individuals. And so, I guess to answer your question, the exit strategy is different for everyone, but you want to have your team, but you want to ask that question up front, right? Not after you buy the business. Got you.
And that makes a lot of sense. And as you said before, that is going to vary from person to person. I do know that, like you just touched on there's conversations being had in our community about, generational wealth. And we do know that, particularly like in our community specifically, we know about legacy businesses. We know about businesses in our communities that have been owned by families and been passed on from generation to generation. And the conversation, related to like generational wealth. So an acquisition could be the starting block for that. Instead of you going out and having to, build everything on your own from startup to whatever point, you might find yourself in a position where you find someone who's just ready to get out. You have, the tools to not only, run that business, but eventually make it, grow and thrive. But so those are, again, things that you can, keep in terms of the generational wealth conversations that we're having. Okay, so, going back into it, my exit strategy with the Planet Smoothies, I really entered into it with a mindset similar to the business that brought me into it, which was buying and selling and rehabbing houses. And so with the smoothie businesses, I saw it as, one, it was an opportunity. I knew that at that particular time, I had kind of a community of people that I was really, tied into there in Atlanta. I felt that, I could bring that community of people into the business as potential supporters and customers of the business, which would ultimately increase revenues and sales of the business. So adding to the value of it. And in addition to that, there were repairs that the previous owner had not made and was not willing to do so. Again, he was just tired, ready to get out. So I was in a good position where I saw myself being able to come in, make those repairs, and also again add to the value of the business itself. And correct me if I'm wrong, the 7A loans are 10-year loans, correct?
Yes. SBA, there are two types of SBA loans.
Okay.
We're going to focus on just one today to keep it simple, but you have the SBA 504. That's for commercial owner user real estate and equipment and long-term assets. I won't really go into that too much.
Right.
To be helpful, but a significant amount. We're talking, $20+ billion of SBA loans per year are under what they call 7A.
7A.
Yeah, I don't know why they use 7A. I know there's a reason. I don't know what the reason is, but that's 7A. And what is a 7A? It can be a term loan. It generally is a term loan. Term loan, 10 years, meaning term, you pay me over 10 years. That's the term. Right. And principal and interest is paid each year. And the bank can structure the 7A loan less than 10 years. However, generally it's 10 years.
Yes, 10 years. Yeah. So I think, our loan was a 10-year loan.
It was.
I had it in my mind that I was going to, given the financials and the money that I knew that was coming into the business, I really wasn't going to take any owner, money out of it. But because I had my other things going on. And I really saw it as a situation where that after 7 years, that I would be ready to put it back on the market. I felt like, the value was going to increase again. I had an aggressive number in my head. I was thinking, the $600,000 valuation of the business. I was thinking in 7 to 10 years, I was going to have that number at around 1.2. And you said, that's a little aggressive.
Well, yeah. I think, and again, this is my, it's just my experience. But again, you talk about exit, right? Which I do think is important. And frankly, I don't think enough business owners thinking about it in exit, honestly. So I think it's important. I think the key is not even so much whether I'm right, because I might not be, quite frankly. It's more of having the conversation with your team up front, your CPA, your lawyer, maybe an expert within that industry, to say, well, what is a realistic exit sale price? Or maybe in conjunction with that also, maybe there's certain things, metrics and items that would be completed so that you can hit a certain target price.
So you can hit that certain target. So valuation are things to think about. It's just kind of like, again, I know a lot of people are more maybe familiar with real estate in terms of the, say, appraised value of the actual property. They're similar to real estate. Businesses have appraised values or valuations. And so again, going back into it, I really believe that after that seven-year window, that I was going to put it back on the market, and then that's when I was going to cash out and really take kind of what it was, my draw on that particular deal. Now things worked out completely different. The 2009 hit, everybody knows, that's kind of just, common things. So things just went awry, the whole economy in a lot of ways.
If I may say so,
yes,
some people, well, sorry, Quincy.
No, go ahead.
I apologize. I was just going to say, some people may not know, but, there was a massive recession in the 2008, 9, 10. Yes. You could also even say 2011, and it was an economic recession, right? Meaning it affected a lot of different industries.
Right. So I was unfortunately part of that, and so revenue sales went down. I guess people felt like when money got tight that they could make a smoothie at home instead of going out and getting it after their workout. We did have dedicated customers who religiously still came in, but the other things that really had impact my bottom line, which was cost of goods. Everything, all the fruit and products that were coming in the trucks. We had a gas hike, if you recall, that happened in Atlanta, where gas prices went up. Many of the food companies and trucking companies were passing on. They added as a it was I forgot the term that they used for, but it was
Was
an
it like
extra.
was it a surcharge or something?
Yeah, it was a surcharge. It was a surcharge on the invoices for the additional gas costs. So they were passing it on to us, business owners that they were delivering to. So you got, decreased sales, you got increased cost of goods. I mean, it's just that all affects, your profit, your operating revenue, and it just gets to a point where, things are just not adding up. And so that was, had a lot to do with it, and that just, kind of ruined that. But I don't think that I do believe it's still, this is a very good option and alternative. Again, you have to be very strategic and understand, all the components involved in it. But the SBA loan process and acquisition for people, men and women, whether you're formerly incarcerated or not, is a real vehicle for you to, we're not just talking about, getting back out here and just doing okay. This can be, something that can change your life.
So now here's a question. So now the question is, in my mind, I'm asked this a lot. Well, okay, well, how do I meet the right bank or banker that provides SBA loans, right? And I don't have an easy answer to that. I'm gonna be candid, because you can obtain SBA loans in all 50 states. First of all, right?
Right.
I think the key thing is to figure out what are the names of the banks in your community. It might be a large bank, it might be a small bank, it might be a credit union. It might be what I call a medium-sized bank.
Right. Right.
And the benefit of the world now is you do have technology. You can get online and do some research. After you get a couple of names, you want to call several. You want to call several and see if you feel comfortable. See if the banker returns your phone call. Most banks do a variety of things. SBA is just one of them. So you might call the 800 number, and that person might not know what SBA is. I'm just being candid.
Right. Right.
But you want to ask the banker, no different than if you're going to buy a car, right? You're going to go to multiple car dealerships, right? Yeah, you're going to ask some questions. Do you feel comfortable? You're going to compare one bank to the next. You should do so. I recommend that.
Okay, and I appreciate you, and that truly represents the type of character that the person that you are. But I'm going to tell you to pump the brakes just a little bit on that, because
Okay.
we're not going to be so quick to give business to anyone else right now. I want my audience to think of you first if they think this is something that fits for you, for them, and fits for their family, and it's something that they feel like it's something in alignment of something that they ultimately want to do and feel like they can do. I want them to consider you first. So with that being said, Nur, share with our audience the ways that they can reach out to you directly. Nur is, as he shared with me, he's an open book. So tell them how they can reach you.
So, I like to say, my name is spelled N-U-R. It's pronounced Nur. I like to say N-O-R. My parents, who I love dearly, were hippies. It means the light in a few languages. When I was in third grade, it was like, how do I pronounce this? As I've gotten older, I really appreciate, my parents naming me Nur. I'll be candid. I'm a phone guy. You can call me on my cell. So I'm just going to give you my number right now is area code 323-627-1177. Again, I'll say it again, 323-627-1177. If I can't help you, I'm going to help you find the right banker. That's just kind of the thing that I like to do. I do that all day long. You can certainly reach me on LinkedIn. My first name, Nur, N as in Nancy, U-R, and then last name Nadir, N-A-D as in David, I-R. So, that's the best way to reach me.
That's what's up. And we'll have during the episode, your information will come across the screen. We'll also have your information down below in the description. And I encourage every one of you, if this information was valuable to you, to reach out to Nur, and he's going to help you, get through the process, tell you what you're going to need to do to get in alignment. And again, he can talk with you about other things that you might need to do to try and get your deal structured. But again, brother, I appreciate you. This was an awesome episode.
I'm humbled.
I'm going to be looking to do my own deals with you as well within the next year as well. So we're going to have some more conversations offline as in this process. And other than that, again, I want to thank everybody for tuning in to today's episode. And as always, as you know, don't let your setbacks ever keep you from your success. And again, until next time, we'll be back. Excuse me. And until next time, we look forward to speaking to you again soon. Peace.